Last week, we talked about the ideal financial product. Today, we're going to talk about the ideal financial tool. Stay tuned.
From Philadelphia, the home of the Liberty Bell, Financial Freedom Radio starts now. Here's your host, Raymond Jewell.
Welcome, everybody, to financialfreedomradio.com. My name is Dr. Raymond Jewell, and I'm going to be your host for the next 15 or 20 minutes or however long we take. Today, we're going to dig the ideal financial tool, which we called last week the ideal financial product. But we've had a number of people ask questions, so we want to answer the questions first. But first, let's bring in our illustrious producer. How are you, Steve?
Hey, Ray, how are you? That was quite a build up there. I don't know how illustrious I am. It's funny. I didn't even want to bring this up, but I'll just talk. This is how weird this day has been. I got attacked. I just came in from taking the dogs outside, and I got attacked by a bug as we're running the intro. So the intro was a little off today. That was me. I'm trying to figure out. He was on my neck, and now he's gone, and I don't know where he went. So if I freak out in the
Did
middle
you
of the show, do
you
I?
killed it?
No,
You killed
it
it?
was crawling on my neck, and I picked it off, and I thought I threw it
You
onto the
you
ground.
you took a life?
I did not take a life.
Okay.
I simply tried to remove it from my body, but now I don't know where he went. So I'm a little
Okay.
freaked out right now. Anyway, yeah. So
I think everybody's all excited about your bug.
well, they should be excited about this show. You know, last week was one of the biggest watched, listened to shows that we've had so far. And, you know, at the end of the show, after we wrapped it, I had questions. And then come to find out, a lot of people asked me questions about the show. So I thought this would be a good opportunity for us to just kind of dig in and do kind of a little Q&A with some of the questions I had and some of the questions that other people asked me. So I thought we could kind of entertain that idea for this show, if you don't mind me trying to hijack your show again.
No, that's fine. As long as it's in the best interest of the consumer.
Oh, stop. You're just being so silly. Okay. So one of the things one of the things you mentioned last week, I'm kind of going off script here a little bit, but one of the things you mentioned last week that really kind of threw me was I get the idea of a whole life policy is basically it's kind of a glorified savings account with a death benefit. For all intents and purposes, isn't that kind of true?
No,
It's not even
no,
close. Because
no.
here's what I
It's
heard.
more sophisticated than that.
Absolutely, it's fancy. I mean, you're putting money into it on an ongoing basis, right? You can take money out of
Right,
it. You can borrow from it. What really caught my
right.
attention, and what I really had a hard time grasping, was I'm paying money into a policy, and when if I get injured, disabled, whatever, and I'm unable to do that, the company is going to continue to make that payment for me. That doesn't make any sense why they would do that.
Right. Well, it's a disability portion of it that it's a rider that attaches to the policy. And if you become, see, you need life insurance is a very vital part of people's portfolio. And it does many things, but we have the internal rate of return, external rate of return, and eternal rate of return. So, in order to satisfy all those, you have to have something that's non-interrupted. And so, if the thing that can interrupt and devastate lives, number one is death. We all know that, and it can financially ruin people because it you lose the income of an individual depending on how much that income is in their family life. There's a term in economics called human life value. It was, I believe, coined by Solomon Hebner, who wrote a book called The Economics of Life Insurance, and he was a professor at the American College, and he wrote about human life value. And what that is a value that we have in our lives, the value that we have to our families, the value that we have to our business. Whatever we do, there is a value. And so whenever you have, let's drill it down to human life value, whenever you have a human life value, that's the value you have to your family and your spouse. And
Right.
she has a value to you. So you want to try to calculate what that value is and determine and make sure that you ensure that human life value. So as you start to get older, you have a greater value when you're younger because you have more earning years. But as you start to get older, your earning years start to drop off. But yet in retirement, you have human life value that translates into medical conditions and taking care of things that you don't worry about when you're younger. So you want to make sure that you protect that human life value. So at a young age, you protect it with a disability part of it, and as you start to get older, you've got the disability. Now, most, I'd say, pretty much all of them, all of the whole life policies have the disability drop off at age 65 because then you qualify for Social Security and you're in retirement. But at 65, depending on the age of it, you've got all sorts of things you can do within that policy to make sure it continues on. But disability protection is a vital part of a macroeconomic model. And when you get it in one portion, you now have assured yourself and your heirs that there's going to be something there no matter what happens.
Wow.
Make sense?
It makes sense. It's just it seems to me such an unusual concept that the company would be willing to put money into a financial vehicle for me on my behalf. It's like, hey, listen, you can't do it. We're going to do it for you. It's such an interesting concept. I just never even knew something like that even existed.
Well, it's a rider that you pay for. It's part of the premium.
Okay. So part of what you're paying
But
for is the
still,
privilege of having that done for you.
yeah, you could do it without it, but it would be silly
Right.
because see, all these financial people sell term insurance. Let's look at what term insurance
And
is.
that was one of the
When
questions I
you're,
got. The difference
oh,
between term and
okay,
whole
you want to,
life.
okay, so when you're young, all insurance works like this. When you're young, there's a minimal chance you're going to die. I think the last statistic I heard was less than 0.5% or 1% of people that had term insurance actually die while they have it. But the chance of you dying is very slim. But as you start to get older, the chance of you dying gets greater. And so what do the insurance companies do? They increase the premium as you start getting older in term insurance
Right.
because they're willing to take the risk when you're not going to die. But when you're getting older, they want to minimize their risk. They don't want to take it, so they keep jacking the premium up. And eventually you're discouraged from having it. Or it will expire at a certain age. Usually it's age 70. Whole life works the same way. It's a minimal chance you're going to die, so there's not a lot of cost of death. So that money goes into a pool of money. And when you look at the whole thing in total, your pool of money is growing, and I think most of them are guaranteed 4% on the guaranteed cash value, and then you get dividends. See, there's two types of insurance companies. There's a stock company and there's mutual companies. Stock companies pay dividends to stockholders. Mutual companies pay dividends to policyholders because policyholders own the company. So the more efficient the company is in running their business every year determines the amount of dividends they pay back to the policyholders. But the term insurance part is what it's called term. So what a lot of financial planners will do is they'll sell you term insurance because it's an easy, cheap way to solve a problem. But it's very inefficient because you get nothing back. And so when you pay for the premiums in a term insurance policy, you have a lost opportunity cost on those dollars. You have to look at those dollars going out the window. You have to say, well, if I could have kept them and put them at the current rate of return that I'm getting on other things, what would I have gotten? And that becomes a lost opportunity cost. You lose the opportunity to invest it elsewhere. So with whole life insurance, you not only have no lost opportunity cost, you have growth on your money. Now, a lot of people say, well, it doesn't beat the markets. Well, when you look at it in total over the long run, insurance policies have beat markets. My insurance policy have beat markets because when people have their money go down, when like we just saw recently, the money's contract.
Hmm.
They lose. And so if you've got $100 in the market and you lose 50%, you're down to 50. Well, people say, well, I'll win that back. Well, yes, you can. It may take you 3 or 4 or 5 years to get that 50 back, but in reality, you should have had 150 because you lost 50 and it just dissipated into thin air. And so people say, well, it's not a loss until you take it. That's true, but on the books, it's a loss that you have to work to recover and then go even higher. Well, in your insurance policies or any kind of instrument that has a guaranteed floor, it never goes down. It just keeps going up. So when the market went down, I lost nothing. People lost nothing that were in insurance policies. And there's other instruments too. There's like
And
annuities and
and it's
that
not
kind of
just
thing.
you should stay in. I mean, we're not talking about this as the only investment vehicle that people should be looking at, but this is one of them. So we're not saying that it's the market or a whole life policy. We're saying that a whole life policy is a way to protect some of your assets, right? I mean, you're not talking about
It's
it.
a
This isn't an either or proposition.
no, it's not an investment. It's a
Well, it's an investment if it's
it's
giving you
a
money back, 4% rate of return.
yeah, but what you want to look at it becomes an economic tool. And that's what I was talking about when I introed the show. It's a financial tool now that enables you to take these dollars and grow more. And so
But that
we've
is that
been
the
through
same as an
use and growth.
investment?
Well, if you take your money out of an investment, you stop earning. So if I were to take there's ways to take money out of these tools and then use it and grow more money. And while you have it out, it's still earning growth.
Can I summarize this question, the difference between term life and whole life? Let me just ask you this. If I stop paying the premium on a term life insurance policy, I say I don't want to pay the premium anymore. Is it fair to say I have nothing now? I'm only insured or I only have a policy as long as I'm paying the premium?
Correct.
So
It
versus a whole,
lapses and
it lapses and then you have
and
nothing. It's basically thanks for the free money. We were
you
willing to
stop
pay out a
paying, you have a 31-day grace period, and then it's gone.
But the insurance company is saying, "We're willing to pay a death benefit to you as long as you keep paying us a premium, but once you stop paying us a premium, thank you for your money, have a nice day." But with a whole life policy, I'm paying the premium into something, and if I stop paying, I still have that something. I mean, assuming that I've gone past the first few years. Let's say I'm 10,
Well,
15 years into a whole life policy and I stop paying. I still have an asset there, right?
right.
Okay.
Correct.
All right. So that to me, that's kind of a big summary of the difference between the two. So the next
Okay.
question we got was how much money do you need? And this could be too vague of a question, but I'm going to ask it anyway. How much money does somebody need to get started with a whole life policy?
Well, there again, it depends, and I don't mean to be evasive with this, it depends on how much you're willing to save. At a younger age, you could put away $50 a month and get maybe $50,000 worth of coverage or whatever, and the savings account grows. As you're at a young age, you can get a lot more than you can get when you're in your 50s.
So someone in their mid
So
20s or late 20s
It's
Could
you
start with
fit it
$100 a month.
into their you gotta look at their macro model, and then you can decide, you can see where there's dollars that they can put away.
Right, but would an insurance company you're again, you're going back into the modeling. I'm just talking about from a policy point of view. If somebody wanted a whole life policy, could they get one for $100 a month?
Sure,
Okay. So really
sure.
there's no minimum limit. Some of these places you're like, oh, you got to be able to put, at least $500 a month in. It's like
No, no.
with a whole life policy, it's what you put in will determine the quality or the coverage or something like that. If I put in more
Sure.
money, then I'll get more coverage. If I put in less money, can I up it later?
No, a whole life, once you start, that's what it is forever. It's like your mortgage. Once you contract to pay a mortgage payment, that payment never changes. So as inflation goes up, that payment stays low.
So
So
let's say I'm in my mid
you're
20s.
you're you have to get another one.
Okay. So could I get another one so let's say I'm in my mid 20s and I'm paying $100 a month. And then all of a sudden I get a good paying job and I'm making 50, $60,000 a month. And now I want to put $500 a month into the policy. Could I get another policy for 500, stop paying the 100 and then basically have that sit there
No,
and
you
have another?
keep paying the 100.
So I
Keep
put
paying the
one.
100 and pick up another one.
Okay. So
See,
you get a more than
the
one.
and this is something we've not talked about. The longer you have that policy, the more seasoned it becomes and the higher the dividends go. Eventually, the dividends could exceed your premium.
So, and at that point, does it pay for itself?
You could. Why would
So
you if you're got if you're for every dollar you put in your insurance policy, if you're getting $2 credit into the cash value, wouldn't you keep putting money in there?
yeah. You answer the question. You can get started with virtually nothing.
Right.
Okay. What about this is a life insurance policy. What about health requirements?
You got to pass physical. Depending on your age and how much you're asking for, sometimes they'll take a risk for a lower amount without a physical, but yet they will have a paramed come to the home and actually look at your health, check your blood pressure, check all your vital signs, and look at you physically. You got
If
to There's a weight category that you got to fit within, and so you can get turned down.
could you if you get turned down for let's say I'm trying to get a policy for 500 and I'm making up numbers just to keep the math simple and keep the concept simple. If I want to get a policy for $500 a month, it's got $1 million coverage and they say no, but we would give you one for 50,000 coverage for $100. If you get declined for one, could you get one less?
Yeah, it's called ratings, and sometimes they'll do that based on your health, and
I guess my
it's all
point is I'm
determined.
kind of older, I'm kind of out of shape, I have high blood pressure, so I may not be able to get the policy that I want, but I could get something now to get the ball rolling while I'm getting my health in shape, while I'm getting meeting the requirements of the policy I want, and then once I get there, then get another one of the way I originally wanted it. Could I do that?
It, de- it depends on what the medical comes
But it's
back and
possible.
determines. It's possible, but it's called a rating. They'll charge you more money for lower coverage.
Gotcha. Okay. So even though I can get it, they're going to charge me more because of the rating.
Maybe.
Okay. So this was
Lay off
another.
those Twinkies, Stevie.
I don't eat Twinkies. I eat
All that
reasonably
Mountain
healthy now.
Dew that you drink.
Oh, stop it! It's diet caffeine free Mountain Dew. It's basically bubbles and aspartame. Um. All right. So the next
Oof.
question I got a lot was why are there no financial people talking about whole life? They all seem to be talking about term life policies. I think you kind of covered it, but here's a chance to talk about it a little bit more. Why is no one selling this?
It's interesting. You really don't know what the financial planners don't know. And so when they're not working in a macroeconomic model, it's easier for them to convince people to buy term insurance because that is I hate this term, conventional wisdom. I don't know if I've explained it, a little bit of weed stuff. John Kenneth Galbraith coined the term, he's an economist, coined the term conventional wisdom. It was a way of explaining away untruths. So what they would say a lot of times is buy term and invest the difference. And people hear that enough, so they end up thinking that that's the right thing to do, when in fact, it's wrong. It doesn't make any sense. It can be proven wrong, uh, and you could see the flaws in the model. But it's easy for them to sell a term insurance policy because it doesn't require a lot of money, and then get people to put money into a fund, and they get to manage that money. A lot of them look for money under management. And so it has to be in the best interest of the consumer as to whether you should go that route or not. You can't look at something in micro and accept it as macro. You got to look at it in macro first and then attack the micro. But it's easy for them to do it. And a lot of them are looking for mutual funds and things like that they could get money under management because they get paid a commission off of it. They get paid a commission off the term, they get paid a commission off the whole life. But it's harder to sell whole life because of the bad press that it's gotten. So when somebody sees how the whole life works within the model and they understand the model, they see it for being a logical step. But without that, it's very hard to explain to someone. So when you look at the model and you see the pieces in the model and how they fit together, you see that you need to take the logical steps to solve the problem. And that is to get financial security, build wealth, enjoy wealth, and leave it to your kids or your heirs. And if you don't like your kids, you can leave it to a charity, whatever.
Okay. All right. We're out of time. So anything you want to say to wrap up?
Okay. Well, thank you all for coming and downloading financialfreedomradio.com. I hope this was helpful. And we're going to keep digging into financial tools and talk about how to integrate them into your financial world. So I want to, again, thank you for coming. Share it with your friends, like it, and subscribe, ring the bell. Then we'll see you back here next week, financialfreedomradio.com. Take care. God bless.
Thanks for listening. Please remember to subscribe to the podcast. If you want to learn how to create real sustainable wealth like the extremely rich people do, or maybe you just want to sustain the wealth you already have, you need to check out Dr. Ray's new book, Why the Rich Are Rich. Ray's been coaching clients for 35 years and has completely unlocked the secret strategies that rich people use day in and day out to grow and sustain their wealth, regardless of what's going on in the economy. His book is completely free, and you can get it by going to whythericharerich.com and entering your email address. Again, that's whythericharerich.com. Head over there now.